Good afternoon, everyone. I see we are at the top end of the afternoon on the final day of what's been an amazing event. So I hope we'll be able to keep your attention. Thanks very much for joining us today. And before I introduce the panelists, I'd like to thank the organizers of an amazing week that we have had here. There are too many names to kind of refer to, but there are three names I'd like to call out and congratulate. First, of course, is Ravi Menon, who's been the chief sponsor of this whole event and the program. And the second, of course, is Swapnendu, who's been the chief architect of putting together this event. And finally, Pat Patel, who's our dynamic chief rabble-rouser, who's together with his capable team has pulled off such an amazing logistical miracle. So I'd invite you to join me in a round of applause to the organizers of this event. Let me make introductions of our eminent panelists. So to my far left, we have Wei Hopeman. She's a co-founder and managing partner of Arbor Ventures. Prior to Arbor, Wei was the managing director and head of Asia for Citi Ventures. Prior to joining Citi, she established the China office for Jefferies and Company and was a technology investment banker in the Silicon Valley with Goldman Sachs. She currently serves on the board of Arbor, Akulaku, Quartly, and Silot. Wei brings with her a unique set of experiences and perspectives in finance and technology spanning the Silicon Valley, Greater China, and Southeast Asia. Thank you very much, Wei, for joining us today.
Thank you.
Next to Wei's right is Jussi Salovara. He's the co-founder and managing partner for Antler, a global early-stage VC with over 250 companies in the portfolio globally and is headquartered in Singapore.
600.
There's an update for you. Before Antler, he was the vice president at Nokia's headquarters in Helsinki, running product strategy, sales, and commercial functions. He has also had his experiences built across working with companies such as McKinsey, Deloitte, and Morgan Stanley. Thank you very much, Jussi, for joining us today.
Thank you.
To his right is Jinesh Shah, who's a managing partner at Integra Partners and was formerly a partner of Diamond Asia Ventures with over 20 years experience in Asia Pacific. Jinesh has managed over $200 million in public equities, structured $60 million in early stage private equity deals, and contributed to the issuance of more than $10 billion in public debt and equity transactions. Welcome, Jinesh, and thank you very much.
Thank you.
And finally, to my left is Deng Chao, or known as DC. He's the CEO of Hashkey Capital, which invests in crypto and blockchain globally through 3 dedicated funds with more than $1 billion in client assets under management. Previously, DC was managing director at Data.yes, a data intelligent fintech company and a core founding member of the Wanxiang Blockchain Labs. DC started his career with Bosera Asset Management. Thank you very much, DC, for joining us.
Thank you.
In kicking off this afternoon session, I was sorely tempted to go back to my English books and refer to Charles Dickens. And I think you would know where I'm going with this. It is truly a tale of two cities that we are witnessing today. And I picked up, and pardon me for the lightheartedness about this, I picked up 2 cities that perhaps describe our current existence. One is the audacity of our collective vision for fintech, which actually is what creates the momentum and creates the ability for us to come together from around the world to participate in a program like this and create the vision for the future. At the same time, the other city that we are dealing with is the adversity of factors that have created a twist in our roadmap to achieving that vision. And I don't think I need to elaborate. I think that narrative has been played out several times on multiple forums and panels during this week. We are well aware of the environment that we currently operate in. But to paraphrase Charles Dickens, what he said, and it is amazing how it applies, it was the best of times, it was the worst of times. It was a season of light, it was a season of darkness. It was a spring of hope, it was the winter of despair. We had everything before us, we had nothing before us. Some of its noisiest authorities insisted on it being received in superlative degree of comparison only. So to me, just looking at my English textbook today and referring to this, I thought, what better person to describe our current existential state than Dickens? But having said that, I think the topic of the panel today is more grounded in the reality of what founders and investors are going through. The panel today will look at the most important enabler for the growth of startups, which is securing venture capital. But we know that it can be notoriously challenging in the good times and certainly in the current times. In the session, together with our eminent panelists, we will examine how startups can position themselves to win investments. And that's where I'm hoping that our panelists will kind of unpack what is it that they are seeing and what has changed. We will also talk about what aspects of the operations does a VC look for, both in terms of the numbers and beyond the numbers, and in particular, what do they find persuasive? And finally, we will look at what young businesses should be looking for. The focus of today's discussion is going to be on early stage capital, and therefore, what should young businesses be looking for from their investment partners beyond the check? And when they get down to actually doing a deal, what are some of the secrets that our investors can unlock for founders today? And hopefully with that, the founders in our audience will go away better informed for their next raise. Before we jump into the topics, I just wanted a show of hands, if you will indulge me, on how many founders do we have in the audience today? Oh, we have a sizable number. That's great. And how many investors do we have in the audience today? That's great. I think this is going to make for a very good discussion. Before we jump in, a brief introduction about myself. I'm with the Singapore government on a secondment with Asian Development Bank, and my focus of my work is to help institutional fintech investors, basically accelerate value creation and inclusive impact. And rather than a reformed banker, I'd like to think I'm a transformed banker, having spent a good chunk of my career within Asia as part of the growth trajectory of financial services. Let's get started with some opening comments by each of our panelists to set the stage for the topic of our discussion. And Wei, we will start with you to kick it off. And really the burning question is, what has remained the same and what has changed for early stage founders looking to raise? And if we flip that around for early stage VCs looking to invest, if you could, in your opening comments, share some thoughts to kick it off, and I'll request each panelist to share theirs as well.
Well, first of all, thank you for having me. I think what has changed and how you look at that also depends on your time horizon. Obviously, over the past 12 months, right, we've seen traumatic changes in the overall macro environment, geopolitical tensions worldwide, and obviously with that, right, impact on venture fundings, pace of deals, valuations. But at the risk of dating myself, my first job on Sand Hill Road in Silicon Valley was 2001. So I've seen this story played out a couple of times throughout my career. So from that perspective, not a whole lot has changed if we're willing to learn from history. So you can say to your comment of a tale of two cities, it could be considered a really bad time for founders and investors, but it's also a great time to be a founder and great time to be an investor. Now there's a lot less noise, a lot less competition, right? You have a great idea. 12 months ago, I can guarantee you the next day you'll have 50 companies trying to do the exact same thing overnight with free money being poured at them. Today, it's a lot less scarce. That means the good ideas will win. The solid entrepreneurs can actually have time to think about what it is they're trying to build and to actually hire and retain talent easier than they were able to do even 6 months ago. And as an investor, it's a great time to be investing because we can actually take our time to learn the business, to do our diligence, to get to know the teams, and to really help them build their businesses over time.
Thank you, Wei, for that. Justy, how about your thoughts?
Yeah, so I'm not going to go for the it's either this or it's that kind of viewpoint here. There's never been a better time to invest or start building a company than now. Never.
You heard that here for the first time, right?
The enablers are better than ever. The environment is better than ever. Your digital adoption rates are better than ever, especially in this region. And when times are tough, it's a great time to just focus on building. There was a lot of craziness. Jinesh and I were just talking about it before we stepped on stage, that the markets were insane. I'm not going to now waste time in the panel talking too much about examples, but there were just like complete nonsense. There's complete nonsense that people don't necessarily talk about in the public eye. And it's fantastic that that is kind of out of the way. Crazy valuations, like basically teams that should not have gotten funded got funded. And right now, that forces people to really focus on building a great product, and there's never been a better time for that. Talent's better, more available, and I would just recommend all founders to look at the world that way, and also like all investors should have a long enough time frame that the short-term noise doesn't matter. So, never a better time.
Thanks, Jussi, for that resounding reaffirmation. Jinesh, how about you?
I think it's been pretty much covered. I would say the only thing that's really changed in our mindset is that the cost of capital has really shifted. And I think that in the next 10 years, founders who are building on a first principles basis are more likely to succeed. I think that in a low interest rate environment, all manner of sins have been committed. And I think that the next 5 years, that will not happen. So I think that there's a big adjustment that's going to come. And I think it's a healthy one. I think that reset is very important, both for us as investors, as well as for founders who are building sustainable businesses. I think the sustainability component of building a business was pretty much lost in the last couple of years, given the dearth of capital. So I think that adjustment is what's going to drive value.
And that's a super important point. I think the correction has actually helped build a sustainable future for this industry, and we'll talk about that in a bit. DC, what are your initial thoughts?
Thanks for the great questions. And my panel, my fellow panelists and I, most of the in the audience are from more mature industries, finance, PE, VC investing. I'm from a more early stage area, blockchain and crypto. For my industry, I think it's a good time. It's good time now because the blockchain technology is a new technology that gives us empowers founders to do business cross-border. This technology gives us the power to transcend geopolitical boundaries. At the application level, we see a growing number of applications are gaining broader application, mass adoption. And one particular area that excites us is regulation. Regulation, in particularly in Singapore, is getting more and more clear. Mm-hmm. And broadly in other Asia-Pacific areas and in US, the regulatory framework has been becoming more and more clear. We will be announcing later today that we will get our AIP license in asset management today. So I cannot speak for all investment in all areas, but for my industry, the blockchain and crypto space, it's a good time for us.
Excellent, thanks for that. And to summarize, so Wei said we've seen this before. It's a cyclical nature, and I think the principles have not changed. Jussi reaffirmed there's never been a better time. Jinesh has talked about first principles and sustainable models coming back, and DC shared the excitement on blockchain and crypto technologies worth investing in, and we'll watch out for your announcement later today. So let's jump right into the kitchen now, and Jinesh, we're going to have you kick it off. So when kicking the tires on a deal from an investor standpoint, I presume the broad categories of risk that you might look at perhaps are category risk in terms of how scalable is that particular category. Are they solving a meaningful problem with impact What are some of the risks that are involved in growing the business in that category? The second would be founder risk. And the third would be execution risk as you get down into the terrain, and particularly in the Asian context. Can you unpack the thinking for us from an investor standpoint? For example, does founder risk outweigh everything, or is execution the most important thing in the Asian terrain? Please kick it off and then we'll go around it.
Yeah, I mean, for us, I think risk has to be weighed in the context of the reward. And when we think about investing, there are three key drivers around the risk framework, or our mental model around the risk framework. Firstly, the stage of a company. At a seed stage, what do we know beyond the founder? How can we assess execution risk, category risk, or any type of risk when it's at that stage? So for me, it depends on the stage that the company is at that defines which risk you want to assign to it. The next part is around capital intensity, the business model. If you think about businesses today, whether at SaaS or marketplace or B2B or B2C, the capital intensity of each of these business cases has to have a different founder quality, a different execution capability. A later stage company is all about execution. And back to Wei's point about being able to hire the right talent to scale to that point in your cycle and in your evolution. But the one that I think we care about the most, and is not probably in the list, is timing. I think Wei mentioned earlier as well, or maybe Jussie, apologies, but timing is super critical for us as venture capitalists. And so finding the right investments and the right founders at the right time is very, very important. And there is no secret sauce. If there was, I don't think any of us would be managing external capital. We'd be all sitting here pretty rich doing what we want to do. But having to weigh that risk framework is super important when you think of those three factors.
Yeah, and you make a great point about timing. Timing is often everything. And I'd love to hear from Wei on picking up on what Jinesh mentioned and the way you guys look at it from an investor standpoint between category, execution, founder, terrain, etc. And we're talking about early stage. So assuming that we're talking about Series A.
Yeah, I mean, we're primarily early stage investor, 80% of our deployments in seed and A. So founder and the team, not just the founder per se, but the founding team, or at least the ability to build a team is super important, right? Does the founder have enough IQ to understand what he or she knows and doesn't know? And can they recruit the talent around them to build to their vision? And at the end of the day, we all know startups, it's a very challenging journey, and it can be a lonely journey. So it takes a particular mindset to be able to weather through the tough times. And somebody who's stubborn enough to want to be a startup founder, but also be willing to take advice. And it's a tough balance to navigate, but that balance is extremely important. I think for us, because we specialize in fintech, right, in this this environment, Dan mentioned earlier, regulation is something that you can not get away from anymore. So as a founder who has enough regulatory IQ is super important. Knowing when and how to engage with regulators before you get regulated is extremely important in this day and age. Obviously, execution, once you have an idea of the product and thinking about go to market, we try to be helpful as investors. We're mostly a B2B investor, so we spend a lot of time helping our companies think through, right, their go-to-market strategy. What are the right channel partners to have? Who are your first initial customers? And how do you work with your initial customers without being bogged down by them or become a tailor-made solution for that particular customer? That's important. But I think it really comes, for us, the founder and the psychology is extremely important.
Those are great points you make. And so we've heard about timing, we've heard about regulation. Jussie, Antler sits with the founders even at a pre-idea stage. How do you guys look at making an investment across the various aspects we've spoken about? Are there other things that you look at, particularly in the Southeast Asian context?
Great question. I mean, we are as early as it gets. We call our approach day zero investing. It's not day 30 or day 90 or whatever. It's literally day 0. And actually we start engaging with founders at day minus 60 days, day 0 minus 60. But I mean, it's almost literally all about founders. It's exactly what you were saying about being, like, do we believe that these founders are able to hire a great team? Can they execute enough to, build a great business? Can they actually come up with a great idea? So it's all about the founders. A average team will almost never build a fantastic business, whereas a fantastic team will, with a much higher probability, build a great business. So in the early stage, you should never invest into a great business model if it's like, at best average team building it. So that's really how we see the world. We obviously assess the business models and all the other dimensions that VCs do, but like much more weight on the founder side of things, which means individual strength of the founders, the combination, the founder/team business model fit, and so forth. So that's how we see the world, and our business is end of the day about founders. End of story.
Yeah, and in some ways, making that assessment is sometimes the most hardest of them all, in terms of a founder risk. But great point so far. Timing, regulation, founder. DC, what is your lens that you apply when looking at investments based on the discussion you've heard? What else do you guys look at?
I would say two things. One is because most of our investments are at a very early stage. I would say first the roadmap, what kind of a roadmap they set. If the project aims for the right purpose, though it's at a very early stage, we would put right check to a project, to the founder. Secondly, it's about product market fit. We're aiming for adoption. We're aiming for real use. Over the past 7 years, we have invested over 500 projects globally. We've seen so many founders failed in a way that they come from a more engineer background. They are good at inventing stuff. Mm-hmm. But the problem is that they tend to create needs. They invent wheels behind closed doors. So two things. One is the vision, the roadmap. Two is the market, the product's market fit. Yeah.
That's a great point about engineers being very good at what they do well, but often the use case or the actual product market fit is sometimes hard to see. But these are great points made. Thank you very much. Moving on to something that I think a lot of founders do think about as well is beyond the rational and economic case. And Wei, please kick this off in terms of the thinking. Beyond the rational economic case, do investors obviously look beyond the numbers? And if you're looking beyond the numbers, what is it? What is that, X factor, or what is it that is not appearing in the numbers or in anything else that actually creates a kind of a connect?
Beyond, I mean, because we invest so early, a lot of times numbers, to be honest, is all.
Yeah, what numbers?
What numbers, right?
Yeah.
And whatever projections we see, we discount it tremendously. So it's really, for us, it's about what it is they're building, what is the real market need they're addressing, and more importantly, especially today, who's willing to pay for it and how much are they willing to pay for? I think that's something that sort of got forgotten the last couple of years, and now it's becoming increasingly important. So for us, we spend a lot of time in the B2B space, so we spend a lot of time actually, with the large strategists and the corporates understanding what their needs are. And it helps us, it doesn't really necessarily tell us what to invest in, but it helps us triangulate and where the true market needs are, where the true pain points are. And then when we find the right team that's thinking about, that particular solution, then that's where we, tend to double down.
Great. Anyone else would like to take a shot at thinking through what is that goes beyond your, initial assessment? What's the X factor? Is there an X factor? Can you describe it?
I mean, for me, one of the other things that we should do as VCs in this environment is take risk when others won't. So I'll give you an example. In our portfolio today, we've made a couple of investments in Pakistan. 6 months ago, that was one of the emerging markets or frontier markets in the region. Had seen more capital come into that country in a 9 to 12 month period than in the previous 10 years. And now that entire market has dried up.
Yep.
And so I think it's upon many VCs to take risk when others are not willing to. And that can be either geographic or stage or business model. But that's something that I think has to be factored in, given that there is an adjustment in the macro environment. So some founders will not be able to access capital as easily as in other markets.
In fact, there is a question from the floor that connects to what you're talking about. Perhaps you could speak to it. Is there a different calculus to be made in the risk-reward trade-off for Asian startups?
No, I mean, back to my original point. I think the framework we have hasn't changed in the way we invest. Of course, the risk premium for Pakistan is much higher than the rest of the region. But I'll give you the example of one of our portfolio companies. It's a B2B online pharma business in Pakistan. We asked the founder at our LP day just to put up a chart of his performance over the last 18 months. This is a company that's gone from 0 to 60 million in revenue run rate, revenues, not GMV, in 18 months, in a country where medical inflation is running at 15%, quarter on quarter. An amazing achievement. So we asked him not to put up the name of the country that he operates in, just a chart of his metrics. And we went around the audience, and if it was in Indonesia, everyone's hand goes up. If the company is in Pakistan, nobody's hand goes up. And that tells you where risk allocation and capital is. But that's our job. Our job is to weight that risk, assess the risk premium of that market, look at that opportunity in that founder, who is exceptional, and provide capital when nobody else is willing to do so.
And that's a great point. It's like go where others fear to tread, and the business of venture is, after all, finally finding that reward in the risk that others may not be willing to accept.
I'd like to just comment on this, both the question from the audience and to this. I mean, there's like obvious real risk that in a market like Pakistan that relates to particularly exits, and there's some other risk factors. And I think the risk-reward calculus inherently roughly matches what happens in other markets. And to me, the logic goes so that the exits in a market like Southeast Asia are much smaller than they are in, say, the US or Europe. As a result, the compensation is much lower valuations in seed stage, Series A stage. So like both from the founder point of view, or let's say, especially from an investor point of view, it kind of matches. So your kind of risk premium you get for the massive risk you take matches, but it really kind of works that way to me. And kind of similarly in the case of Pakistan, just to build on that, the exit part is what I'm most concerned about myself. We've made investments in Pakistan, currently evaluating one. Let's see what happens with that. So some people call us crazy, but that's the exciting part, right?
Yeah, and Jussi, I want to kind of continue with the theme that we spoke about earlier, where Antler actually sees sitting alongside the founder. And the question now is from an early stage founder perspective, how should they go about choosing the right investor for their stage? Because often first-time founders are afraid to ask the tough questions to the investors. There is this asymmetric power equation that's playing in the background, particularly for first-time investors. And there are questions and there are things that they need to kind of think through about the alignment between the investor and their business, growth versus profit, what kind of value will I get beyond the check? And there's a question to that about funds providing operational support alongside the check they would be writing. So can you unpack that and help the founders in the room, think through about how they should find the next suitable investor?
critical question, and I talked to a lot of our founders about this. So there's first of all a lot of market standard differences in the US. Many founders, especially seasoned ones, wouldn't even want a lot of meddling from their investors, rather just focus on building the business. Investor shows up in a quarterly board meeting and everyone's happy. Here, I think people talk a lot more about this operative support. And I think as a founder, you need to think about what you need and want yourself to build your business. If you feel like you need such operational support, then you probably should overemphasize that a bit in your partner selection. From a practical point of view, what I'd recommend to do is to obviously research the firm. If you have multiple VC firms that are interested in investing, make sure that you don't have any red flags associated with them. And I would almost after that pick based on the VC partner leading the deal who will be on your board. So you need to have good chemistry. You need to understand how they work, and if you're going to have a great working relationship with them. And the way I would research this is talk to portfolio companies of that fund, specifically people who work with that partner, and look for a success case and look for a downside case and try to understand how that VC behaved in each of those scenarios. When shit hits the fan, what do they do? When you're successful, what do they do? And really try to look at it through that. Then you have a very balanced view, and match it to your personality and what you're looking for.
Others on the panel, would you like to share your
I
own?
would definitely second that, right? I think, especially as early stage investors, we're with our portfolio companies for 5, 6, 7, maybe even longer years. That's longer than a lot of marriages last. So it's a real partnership, right? So I think it's a two-way street. Good founders, they can get money from anywhere. So finding the right investor, the right board members is really important. Is that someone going to be willing to take? We have founders that'll call me at 2 in the morning if they're in crisis mode, and I'm there to pick up their phone, right? And you ask the investors, what can you do for me? Can you make introductions to these companies? Can you help me think about who I should be hiring at this stage of my business? What's the next market I should be going to? Do you have other companies who maybe experienced what I've experienced? Can I talk to them? I think just absolutely right. Always interview, right? It's a two-way interview. So we do background checks on founders. You should do background checks on the investors. Talk to their other portfolio companies, see how they have added value over time and throughout the life cycle, right? Obviously, you don't want just fair weather investors. You want investors who can be there with you, particularly during tough times. Right?
Anyone else would like to jump
If I may, at one point is that besides the readiness and the resources to help the funders, another perspective might be if the investor is a patient investor or not. I've met so many investors, after they wrote their check, they were pushing for profits, they were pushing for revenues in the next 2 or 3 years. I think as a real institutional long-term investor, you have to be patient. So for funders, if you're looking for like a perfect marriage, you have to look for someone who's patient.
That's a great perspective, and we've heard some really valuable kind of pointers for founders. And DC, I want to stay with you because there's a question from the floor. What are the criteria you consider before investing in the early stage startups in the crypto realm, especially with the fast evolving technology?
Yeah. I don't think technology is a hurdle. The hurdle stops many from traditional area getting in is their understanding of the fundamental paradigm, if I may say so. One thing in particular is crypto economics. Crypto media or many people have painted the crypto in a different way, but to be more neutral, objective, this is like new economy. Designing the token economics is like designing the economy of a small country. So be careful about how many, what percentage of your token are distributed at the early stage, over how long the time frame you're going to distribute it. It's like a liquid market. You have to well plan it before you kick off it.
Thank you very much for that. I'm mindful of the clock that's running down on us. So I'm going to conclude by asking each of the panelists to make some closing comments. And if there's one thing you want founders to be laser focused on as they prepare for their next raise in the current climate, what would that be? Jussi, starting with you.
Oh, excellent. So I'll go with product. I think in a time like this, building a great product and really focusing on that over kind of financial metrics is the way to go. And I'll cross my fingers that investors also understand that. Southeast Asia has had this plague of early stage VCs focusing a lot on financial metrics, which take same teams to Silicon Valley, you'll be laughed at, right? So I think now's the time to start building businesses out of Southeast Asia that become global or macro regional, not only Southeast Asia, not only copycats of business models from elsewhere. So that's my recommendation and wish for the region.
Wei?
I would say never stop fundraising. It's always going to take you longer than you think, as much as we're all optimists here, because otherwise you wouldn't be a startup founder and we wouldn't be venture investors. But you're never going to be upset that you have too much money, but you will be very upset when you're running out of capital. So always have longer runway than you think you'll need.
Product, long runway, Jinesh?
Sustainability of your business model. You can raise as much money as you want, but if it's not sustainable, it's going to be tough. So sustainable business models, I think, is also super important. And you have the luxury to be able to do that now because the craziness in venture is going to dissipate. So maybe going back to first principles.
First principles. DC?
I'm saying a little praise about my industry. The blockchain technology will change the way we work in life. Like internet has been changing our way of working in life over the past few decades. If you are in a very competitive industry, which has become a red ocean, you may take a look at opportunities in our industry. It has opened doors to a lot of new business opportunities.
And that's a wrap, folks. Please join me in a round of applause for our expert panels who have helped unpack several burning questions. I hope founders have taken copious notes. Many thanks for joining us today. I wish you a great rest of the day ahead. Thank you very much.
Thank you.